Good. So let's go through the question. The first one, we said that where are you? Good. Good. So the first one, the difference between the conceptual framework and the regulative framework. So what you said is true. Correct. Now, the conceptual framework, it only prescribes how the financial statement should be prepared, the objective, the reason, the basis, the assumption, the principle, but everything about the financial reports. Whilst the regulatory framework talks about the rules guiding the preparation. So the specific rules and specific transactions, specific requirements, that's the regulatory framework. How we get that?
Yes, please.
Good.
So the conceptual framework is more of the principles.
Exactly.
The principles. Whilst the regulatory framework talks about the specific, the rules governing how
specific requirements
transactions are treated.
Exactly. So if we take the regulatory framework, for instance, an example of regulatory framework is the IFRSs. The IFRSs will give you a specific law, a specific rule, specific requirement, specific treatment of the transactions. Whereas the conceptual framework provides a guidance, general principle on how the financial statement should be prepared. To just prepare the environment. The conceptual framework will just lay the foundation, prepare the environment, prepare your mood. Will let you know the objective, why you are preparing the financial statement. Will let you know the assumption that you have to bear in mind. Will let you even know the characteristics that that financial statement should even bear. Then it will also let you know the element that you should bring them, and it should let you know the recognition, how you should treat the transactions. Good. That's what the conceptual framework will tell you. But with the regulatory framework, it will go further to provide rules on how to measure these transactions. How we get it?
Yes, please.
Good. So that is it. Now, the B part of the question states that define and discuss the fundamental and enhancing qualitative characteristics of accounting information. Now the question is, how do we go by this? Define and discuss what the fundamental and enhancing qualitative characteristics of financial statements.
So, it's more about the gap. The fundamental has to do with the going concern.
Okay, good.
Where the going concern tries to explain that the business will still be in continuous business in the foreseeable. Okay.
The qualitative characteristics deals with the features or the attributes that the financial statement should possess. And then there are two broad classifications of such features or such qualities. They are the fundamental, and some two are enhancing. So when you prepare the financial statement or when you present the financial information to that of the users, you should possess some qualities. So what are they?
Okay. So the qualities it should be fair. It should be complete. It should be fair and complete. Yes.
Yeah.
Yes.
Good.
So these are the two. So it should be fair and then complete. And it should also be it should be relevant. The information in it should be complete, relevant, and fair. Yeah.
Okay. Good.
To the users.
Okay. With the qualitative features, we have grouped them into two. So the qualitative features, we have grouped them into two. Good. So first of all, we have the fundamental. Now with the fundamental, they are the features that make the financial statement useful. That's the fundamental qualitative features. So any feature that make the financial statement useful to the users is fundamental. There are only two of them. One, we have the faithful representation. Faithful representation. Faithful representation. And then the second one is what? Relevance. Now let's explain them in detail. Now with the faithful representation, it talks about, or it states that the financial statement that you have prepared or the information that you are conveying or sending to the users, it should represent the reality, the economic stand, or it should represent what? Your true picture, your true view. No editing, no manipulation, no cooking of books. So that's what the faithful representation is saying. It says that the financial statement prepared or presented should represent what? The economic reality of the entity. The economic reality. That's the faithfulness of the account. It should declare the stand, the actual stand of the entity, not what the organization think should be their stand, or what they have manipulated, or what they have projected. No, it should be the actual stand. So that's a faithful representation. And here you cannot explain faithful representation without some keywords, or to report faithfully or to represent faithfully. The financial statement should be complete. So it means that the item that you are sending or the information that you are conveying to the user, it should be what? Complete.
Complete.
Yes, it should be complete. So that's I normally call these ones ingredients of faithful representation. Two, it should be what? Unbiased. Then 3, it should be free from errors. Free from all material errors. Yes. So your financial statement should not contain mistake. Yes, shouldn't contain mistake. And then lastly, it should be what? Yes, transactions should be reported on their substance, but not the form. That's a substance over form. So transactions should be reported on what? On their substance, but not form. So that's it. Good. So transactions should be reported on their substance, but not the form. So that is it.
So the fair that I said was complete. They are all part of the faithful representation.
Exactly. So the fairness.
I'm asking a question. No?
You said?
Okay. It's a question, so that's
Yeah.
Okay.
This you said?
Oh, I'm saying it's a question. What I said was a question.
Okay. So that is it.
I wanted to know whether the fairness and all those, they are all part of the faithful representation.
Oh, okay. When you say the fairness of account, that's a faithful representation.
Okay. Okay.
The account should be fair. Yes.
Okay.
It should be fair. That's the unbiased section. The unbiased or neutral. It should be.
No.
Yeah. It should be neutral or unbiased or free from errors. And it should also represent the economic reality or the substance. That's the fairness of accounts. Good. And then the completeness. So all of these form under faithful presentation. They are not on their own. So take note of this. Good. So I hope you get it.
Yes, please.
Good. So that's the faithful presentation. Then the next fundamental qualitative features. In fact, the fundamental, there are only two. The next one is the relevance. Relevance. So that's the relevancy of the information. So what do we mean by relevance? We are saying the financial statement that you are presenting to the users or to the owners must be what? Relevant. So what do we mean by that statement?
Okay. Relevance, we are looking at the timeliness of the information, the information, the content of the information is whether it will be relevant to the users, whether it will help in the decision making, whether it's also form part of the economic benefit of the entity. So we are looking at relevance has to do with time. If the time that they need that particular information, the information is not there, or the information is not relevant to the particular user or to the users, then it loses its quality.
Good. So with the relevance, someone will say that, okay, the information should be important or credible. But what we are saying is this. Relevance simple means the information that we are providing to the users, it should be able to what? Influence their economic decision needs, or it should be able to help them to make their economic decisions. So that's the relevance. So if you're going to provide information to your users, make sure that whatever they need to make informed decision is in your information. That make your information what? Relevant. But if you provide information to the users and still they are calling you that, please, can I get this part? Can I get this information? It means that what you've sent to them previously, it is what? Irrelevant. They are now asking for the ones that will help them to make the decision. How they get it?
Yes, please.
How they get it?
Yes, please.
Good. So relevant simple means that the financial statement prepared or the information that we are conveying to the users, it should contain what will influence their economic needs or what will help them to make all their decisions without any difficulty. That's the relevant information. So these are the first two. Now, when we talk about relevance, the relevance or the relevancy of information depend on two rules. Or the information we are sending to them should provide two straight rules. One, we have the confirmatory and then predictive rule. So confirmation rule and what? Predictive rule. Now, with the confirmatory rule of information, it means that whatever you are sending to the users, it should help them to what? Confirm the past and also predict the future. Because whatever you send to them, if today your company have prepared their financial statement and now they are giving you sales of 20,000, that sales should also tell you, should also help you to predict the sales for what? For next year. So they have to give you relevant information so that you can now make your predictions and also confirm the past, because always they'll give you the current information for you to confirm what you predicted last year. So that's the relevancy. Now, you cannot talk about relevance or relevancy of information without mentioning what? Without mentioning materiality, because relevance box onto what? Materiality. Yes, the materiality. Good. So materiality. So information or the transaction is material. Transaction is material if its omission or misstatement could reasonably cause a distortion in the economic decisions of the user. So that is it. The relevance or relevancy of information depend on the materiality level. So if that information is material, then automatically it is what? Relevant. How do you get it? So you have to include all material what? Information. So that is it. And you can also guide the materiality by size or by nature. That's the threshold. So basically, that's the fundamental qualitative features. So these are the two features that make the financial statement useful or strong. Yes, so that is it. Then you go to the second type of the features. That's the enhancing. You also have enhancing. enhancing. Then enhancing are 4 in number. 1, 2, 3, 4. They are 4 in number. We have what? Comparability. We have what? Understandability. Understandability. Okay. They also have what? Verifiability. Then finally, we have what? Timeliness. Yes, so the financial statement prepared, the very first one, enhancing. Therefore, they just write the financial statement, the features, the qualities. Good. Now, with the enhancing, yeah, we are saying that the financial statement that you are presenting, the user should be able to compare this financial statement and make analysis out of it, to be able to obtain the performance, the actual performance of the entity. So by so doing, they have to compare our financial statement, the current year financial statement, to either a key competitor in the industry or our previous year's financial statement to know the performance. Okay, so that is it. Good. Now, for the comparability, it means that we cannot prepare financial statements for just a single period and present it to the users. They may not be able to compare it to any other financial statement. So that is it. Now, to enable comparability, 2 things should be in position. 1, there must be what? Consistency or uniformity in the accounting policy selected. If we're the type that every year you change your policy, then you may not be able to compare well or draw objective comparison or valid performance analysis. Good. Why? Because the basis might not be the same. 2017, the accounting policy is different from 2016's own. Comparing this may not give you the true reflection or the true performance. That is it. And also, second, to enable comparability, there must be what? Disclosure. Oh yes, disclosure requirements. There must be disclosure requirements. Now, if I should put this down, company A, company B, their profit over here is 100. Here the profit is 200. Which company is doing well?
On the face of it, B.
Yes. Now, if I should tell you that A enters into some investments, or A invests for this particular period, and then the cost of investments took or swept away all his profits, hoping that exactly 6 months later, he's going to recoup like 10 times his investment. Now, who is doing well?
A.
Good. So if I don't disclose certain transactions to you, you may end up saying company what? B is doing well. I can also say that, okay, during the year, company B had a contract from the government, unannounced contract from the government, which formed about 80% of its sales revenue. Wow. So it means that 80% of the profits or 80% of the sales revenue is coming from the government. It's not coming from your own direct trading. Meanwhile, company
Yes.
A, all the profit is coming from where? Direct trading. That if I don't tell you or I don't disclose such material information to you, you may end up making a wrong word comparison. So that's why I'm saying to enable comparability, there must be what? Disclosure. Disclose the unique transaction which has occurred to us. So that is it. Good. Now you go to understandability. As the name suggests, understandability. The financial statement prepared should be readily be understood by the users. Yes. So for that matter, we are saying the users should have a reasonable knowledge about the financial and operational activities of the entity. That's the understandability. Yeah, users should probably learn about the financial affairs of the entity. That is it. Then we should be readily learn. Good. Now you can go to verifiability. The financial statement prepared should be able to verify by what? A third party, usually the auditors. How we get it?
Yes.
Good. Yeah, I like this point because in exams too, your answers that you are writing must also be verified by what? A third party.
The marker.
Usually, yes, the marker or the examiner. I like that point well. Timeless. The financial statement or the information that we are providing should be on time, not too early, not too late. Should be on time. So that is it. We are done with that question. Have you seen how that small question kept away time? Yes. It came in.
I was just mixing the enhancing and all those things. I said I was just mixing the enhancing and the fundamental together.
Exactly. So that is it. So
Okay.
you have to put them enhancing. And then the individual features. For instance, a question like this, if you start by saying neutral, unbiased, substance over form, materiality, human, that's not the main feature. They form under the key ones. So the key ones should come first before the individual ones will follow. So that is it. Good. So now let's move on to probably the next question. I hope it's okay.
Yeah, it's okay.
Good. Now the next question says that, so we have defined and discussed it. Assess the advantages and disadvantages of each measurement basis from point of a key user. So what are the measurement bases? So this one is 4x1 matrix, 4x2 matrix. So you pick one key user of, in fact, this question is moving around the measures, the measurement bases, advantages and then the disadvantages, the 4 measurement bases. So you have to explain the measurement basis. Just that here, all your advantages that you're going to coin or advantage you're going to state, it should come from a key user. Good. So what are the measurement bases? They are 4 in number. When you mention them, then we state the advantages and disadvantages to a particular user. Usually you go in for owners or investors. That's the key one that's going in for the owners or the investors. He's a key user. I hope you get that.
Yes, please.
Good. So the measurement base, the first one is the historical cost. That says that transaction or the element or the item should be recorded at their original cost or the initial amount or the historical amount. Asset should be recorded at what? At the original amount at which the asset was acquired. Liability should be recorded at the amount at which you need or require to settle them in an ordinary course of what? Business. Good.
You said what? The liability should be what?
Liability should be recorded as an amount required to settle them in an ordinary course of business.
Okay.
Good. So that is it. Good. Now let's move on.
Okay.
So we will pick the key user. we will pick the key user, which the investor. So there are 4 bases.
Okay.
Historical. So when you pick historical cost, if you are going to record the assets at their original cost, liability to at the original cost, that will be of good to an investor. Yeah. So that will be it. Good. Originally, the importance of historical costs probably is very easy to use, because the items, you don't need any measurement basis where you have to go and assess the market to know your market index. No, all this will not be needed. So that is it.